The Psychology of Money is one of the most popular investing books right now. Everyone is talking about it, and I had to wait almost a month on hold at my local library to be able to finally listen to the book. And after listening to The Psychology of Money, I wanted to share my thoughts. Is it a book that is worth your time to read, or is it a bunch of financial mumbo jumbo? We're talking all about it in today's video. Hey everyone, and welcome back. I am the part-time economist, and in today's video, we are talking all about the psychology of money. It's a super popular investing book, so I wanted to share my key thoughts on the book. Now, before we get started, I did want to make a couple disclaimers. Number one, this is a book review. It is not financial advice, so please don't make your investing decisions based off what I say here today. Point number two, these are my key takeaways. Now, everyone picks up different information. If you've listened or read The Psychology of Money and there was something that really stuck out to you that I missed, feel free to leave it in the comments so that we can all learn together. With that being said, The Psychology of Money, I want to start out by giving a big picture overview. The Psychology of Money isn't a book that's going to tell you put 70% of your portfolio here, do a 35% allocation here, right? This is a big picture book that's more geared to different thought processes and cognition around money. So let's go ahead and jump into some of the key points, starting with everyone has a different experience with money. So this is something that is really important because if we're thinking about ourselves as someone that is investing, as someone that is managing their personal finances, we might want to judge ourselves against other people, right? I wish that I had the dedication to ride out the stock market like this person. I wish I had a savings rate comparable to that person, right? In reality, the way that we each look at money is different. Specifically, we all grew up, we all had our formative years under different circumstances. Just as an example, suppose that you graduated from college in 2008, 2009. You were entering a terrible job market. So you might have more of a pessimistic view of these things versus someone that graduated with a technology degree, some kind of computer programming degree in California during the tech boom, right? It's the same thing if we look back at older generations, right? The generation that grew up during the Depression, they're going to have a very different outlook towards money, towards job security versus the baby boomers, right? Or people that were growing up in the post-war boom period. So everyone has different experiences. Don't judge yourself too harshly when you're comparing your financial outlook to someone else. The second point is to focus on broad patterns versus individual case studies, which are subject to luck and misfortune. So when you're planning where you want to go with your financial strategy, what kind of investments you want to make, right? We can all find the anecdotes, the outliers. We all know the example of some person not going to college or dropping out of college and founding a billion-dollar company, right? They exist. That's definitely true. However, they are the outlier, right? There's a reason you hear about them because the majority of people do not have that same experience. So when we're looking at what we want to do with our career, what we want to do with our education, what kind of investments we want to make, we should be looking at the broad picture, the trends, right? Because that is going to be more likely what we can expect than the outlier. Sure, you could strike it rich with a lottery ticket, but in reality, the more realistic thing is that you're just going to lose whatever money you put on to the ticket. Number three, doing the right thing consistently beats short-term gains. And the example they give here is that most of Warren Buffett's money comes from the later part of his life. So that compounding interest builds up, a lot of things. But the key thing here is that, again, kind of going back to point two really, is that anyone can get lucky in a rare event. Anyone can also experience misfortune in a rare event, but doing the right thing consistently is going to beat those short-term gains. And point 4 might seem a little bit contradictory to this. It says that tail events are responsible for the majority of gains. Now, this seems like a direct contradiction to point 3, but I don't really see it as a contradiction. Let me explain why. If we look at investing, doing the right thing consistently beats short-term gains. To me, that means, and again, this is my financial outlook, doesn't have to be yours, consistently investing in the market, whether it's up, whether it's down, into a broad indexed fund, dollar cost averaging, right? That is consistent investment. Over the long run, I can reasonably expect somewhere around a 10% rate of return, right? Again, those are my projections. They don't have to be yours. The tail events are responsible for the majority of gains. So if I'm thinking about this, even though I'm consistently investing, if we look at the stock market, the majority of returns basically come from a few key trading days. Those single trading days where if you weren't in the market, you would have missed out on the majority of those gains. So the thing is, you don't know what day is going to have a massive gain or a massive loss. You don't know. So by consistently investing and staying invested, right, that's the consistency, you can take advantage of those tail events, right? So you have to have the consistency to take advantage of the tail events. It would be incredibly difficult just to say, I'm just going to get in the market on those high outperforming days. Another thing, and this isn't necessarily related to your personal finance, but I think it's something interesting from the economy as a whole, right? If we look at the companies, the people that are really changing our world, right? They are the outliers of the outliers, right? So look at Amazon. It is an absolutely outlier company with how much growth it has had. But even if we look at Amazon specifically, the majority of their growth, the majority of what has made them huge is a few key products. So it's really the Pareto principle in effect, right? The 80-20 rule. 80% of your results are going to come from 20% of your efforts. So I just thought that was interesting. I do like the book because it's not just finance, so that's one of the points there that you might find interesting. Also, it is better to be reasonable than to be rational. Now, what does this mean? Because to me, looking at this, they both sound kind of similar. What this means is that we can calculate based on statistics, based on probabilities, the absolutely optimal from a financial perspective thing that you should do with your money, right? The key thing here is that people have emotions, right? People, again, going back to point 1, everyone has a different outlook on money. So let's suppose that I know, based on the math, based on the statistics, that for my age, I should be 100% invested into the market with 90% in equities and only 10% in bonds, right? Maybe that is the mathematically optimal model. However, what this says is it's better to be reasonable than rational. Rational would tell us, hey, if this is what the math says, that's what you have to do. Reasonable says, okay, we know that that's optimal. We also know that you grew up extremely poor and you are very risk averse. As soon as you see that market going down, you know you are going to pull everything out because you're afraid of losing everything that you've worked for. So for you, maybe the reasonable strategy is to be 60% in the market, 50%. Have the rest sitting in cash or treasury bonds so that when the market goes down, you don't feel pressured to sell. So you're realizing the market 40% gains versus 90%, which is still a lot better than selling at the bottom. On the flip side, if you're someone that has a finance degree, you're some kind of person that just sits there and loves trading stocks, options, again, the mathematical thing might say, look, you are very likely to lose money trading options. Being a day trader, right? The vast majority of people are going to lose money. But if you set aside a small portion, 5%, 10%, whatever the case may be, right? Some portion of your portfolio and say, look, this is your fun money. Go out there, trade, do your crazy options. And again, it would be better for you to follow the tried and true mathematical method of allocating all your money to the most rationally likely to succeed strategy. But If by doing that 10% allocation to those crazy speculative investments allows you to remain invested with 90% of your money in the tried and true method, maybe that's a better approach than just trying to do something strictly by the numbers where you're going to get bored and then you're going to be speculating 100% of your portfolio into those risky assets. And then the last thing, this is again something that can apply to the financial markets, but life in general. Things that have never happened before are happening all the time. Now, what does this mean? Every day, there's something new. There's something happening that's never happened before, right? There was a first time for 2008, right? There was a first time for the pandemic, right? All of these things have happened now, obviously, but they have never happened before. So when we look at these outliers, when we say, for example, the greatest single day crash in the stock market, I'm making up numbers here, let's say it was 20%. So in our minds, we say, okay, the most I could expect is a 20% decrease in the stock market in a single day because that was the worst that it's ever been. But we have to remember when that 20% decline happened, it was new. It had never happened before, right? Maybe before that, the highest was a 10%, right? So when we're looking at outliers, we should think about them as reminding us that completely unexpected events can happen rather than trying to use a previous outlier to predict the magnitude or severity of the next outlier, right? An outlier is something that can happen. It's something that really can't be predicted. So using previous outliers might not necessarily be an indication of what the next outlier will be. So those are just some of my key takeaways from The Psychology of Money. I was able to make it most of the way through the book. It was a library loan, so I did have to return it earlier than I would have liked to, just so other people could use it. But overall, my key takeaway here is that it is a very interesting book, especially if you're someone that wants to understand more of the mindset of the market, more of the mindset of investing, and not just look at things from a dollars and cents perspective. I think that it's a very good complement to some of the other books that I've reviewed. My personal favorite of all time is probably still The Simple Path to Wealth, but I think this is a very good complement. And if you're into personal finance, if you like learning about money, I think it's well worth your time to read. If you're looking for a specific strategy of how to maximize your profit and how to trade and time the markets, you're more than likely not going to find it especially interesting. So as always, I do appreciate you watching the video. I hope you found it useful, and I'll see you in the next one.